where if you get below 99.50 in the cash dollar index, that's going to be a secular breakdown. You have 10% of downside from there almost instantly, just because of the way it's all set up from a technical basis. So I would say, you're going to see silver much higher when the dollar, is below 100, and it's going to happen fast. And I would almost go so far as to say, when the dollar cracks, it's not a question, does silver get to $50? It's a question of how fast does it happen.
Now through Monday, April 7th, in honor of Silver Squeeze 2.0, for any Monster Box of Silver Eagles, we'll give you 2 additional Silver Eagles at no cost. And unlike some other Silver Squeeze deals, there's no limit. So if you purchase 1 Silver Eagle Monster Box, you get 502 Silver Eagles. If you purchase 10 Monster Boxes, you're getting a full tube of Eagles for no cost. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. With us today for the first time, introduced to us by Peter Grandich, is Greg Weldon, publisher of the Global Macro Strategy Report. Greg, thank you so much for taking the time today.
Sure, my pleasure, Elijah.
Well, it's great to have you on today. I did want to get your perspective on the markets, what we're seeing. It seems like a lot of people are saying we're seeing a topping out of the stock market at the moment. Gold is making all-time highs. You recently reported how consumer sentiment is plunging. What is your broad overview? What is your broad view of the markets right now?
Well, I see stagflation as being the dominant macro force right now, and I have seen this developing really. You got to kind of almost go back to last spring when we saw that you had some of these food items got really high in price and they started coming down. Energy had a base effect that was rolling over to where it was going to become quite negative for several months. So last year, you could see the trend in disinflation coming, where inflation would come down on the PCE from roughly 6%. And we said it would come down probably to 3 to 3.5-ish, and then get sticky, and then begin to embark on another rise when it became evident that the consumer has really kind of been choked out by inflation. And when this became apparent, to where it's become visible more recently, to where the Fed would need to address that, and then that would bring the dollar down and recycle inflation and so on and so forth. And it's played out really, on that timeline to where we saw inflation bottom anywhere between September and November, depending which measure you look at, and then got sticky and went kind of sideways. And if you look at the PCE headline number, it's been above 2.5% for 48 consecutive months. That's 4 years of inflation, 50 basis points or more above the Fed's preferred target rate goal, depending on the syntax you want to use, which frankly, when you get to the Fed, that's very important, the nuance of the words they use. But in this case, you can also see that, you have been above, you've been above the 2% rate for 48 consecutive months, and you've been above 2.5, 45 out of the last 48 months. You have service price inflation on PCE still running 3.5, where if you break down the service price inflation in CPI, there's 74 sub-indexes. 60% of them are still above 4% year over year. Over 20% of them are above 6% year over year. So service inflation is very sticky and still very high. So when you see the Fed all of a sudden with their forecasts at the most recent quarterly meeting, they do every quarter, they update their macro forecasts. They cut their expectations for GDP growth next year, and they do a range. And the bottom end of the range, they cut from 1.4% growth to 0.6. So the Fed is saying we may likely see growth that could be as somewhere below 1% in GDP growth. In the meantime, they revised up their forecast for inflation to above 3%. So this is stagflation. You have higher inflation, you have lower growth, and the Fed will acquiesce to the higher inflation because they have to protect the growth. Why? Because of $60 trillion in U.S. household and public debt. All right. When you look at the last kind of time you had inflation defeated by high interest rates, like the Fed wants to claim victory, but they're never going to be able to get to that point, was in the 79 to 81 frame. When Paul Volcker beat inflation, Ronald Reagan got elected, and you had this big revival. A lot of people want to make this out to be the Trump revival. There's a big difference. There was no debt in 79, 80. So you're saddled with this debt, which creates a big problem going forward. To get back to the consumer has borrowed on their credit card to pay the bills. The consumer at the lower end has been absolutely choked out by inflation. When you have 16% year over year inflation on automobile insurance and stuff like this, it's really hit hard on the person who's making the average household income of around $70,000 a year. You virtually can't live on that if you have a family of four. It's almost impossible. So you see the lower income has been extremely stressed out. And now the big deal about the sentiment that we've talked about here and that you're asking about is you see the sentiment among households making more than $100,000 a year is at the lowest reading in the history of the University of Michigan Consumer Sentiment Survey. All right. It's lower than it was in 87. It's lower than it was in 1990, in 2000 when the tech bubble burst, in 2008. It's lower than all of those times, lower than the pandemic. That's how the more wealthy, affluent people that have been able to afford inflation are becoming victim to it. And here's one more thing to make a long answer shorter. The other thing I would mention too is you've had this cushion against inflation in wage growth. You've had wage growth, there's no doubt, because of what happened in the labor market during the pandemic. And while the labor market's rolling over, which is a whole nother conversation, I can also say that wage growth is rolling over and now moving back below inflation. So as wage growth is coming down, inflation's starting to rise again, you're going to lose that cushion that you've had that has been critical for a lot of people out there to deal with inflation to where you get to the next stage. And I have called this the beginning of the year. I said you would have two things become evident this year. Number one, consumers choking, and you would have a hardening consumer cocoon, where consumer literally cocoons and goes into the shell and doesn't really come out. And secondly, that would lead to an economic reality check in the stock market, which is the most disconnected it's ever been from the underlying fundamentals because of AI and tech and chips and the whole nine yards. So that leadership is gone. So this is a problem going forward. The Fed will have to address this. It's the consumer, being a victim of a stagflation, and now the stock market coming under pressure for the same reasons.
What do you anticipate will happen to the stock market? Because I know, we've interviewed, for example, Michael Oliver, who's mentioned how, the only thing that people have looked to and been happy about in the last few years is, at least my 401k is doing well, and people have often spent more because, their investments are doing well. But if the stock market starts to roll over, how does that impact, consumer sentiment again and spending and all of that?
It's another one of those cushions that you're going to pull out. It's like you're jumping off the building and the firefighters are holding the net and all of a sudden they pull the net away. All right. So, when you kind of look at it, from this perspective, you'd also have to add, that the average value of a household portfolio has doubled since the pandemic because of the rise in stocks, right? Not only that, but the percentage of household assets invested now in stocks is the highest it's ever been. All right. So you have the most people invested with the most money with the biggest gain we've ever had. All right. And you can see this in stocks like NVIDIA, where you track the volume, you track the buying versus the selling price. There's all kinds of tools you can use to measure this stuff. It's so off the charts. Everyone that wants to own it owns it. It's the most widely owned thing. You're not a fund manager that's going to keep your job unless you own these things, right? So what happens with some of these stocks, and some of them are trade $200, $300, $500 a share, when you go to liquidate and you get some normal distribution, which is what we're starting to see now. And it's only the tip of the iceberg because there really hasn't been very much of it. And people go to take profits or lock in some of this money. Who's going to be there to buy these big, shares that could potentially be for sale? You have the potential for what I call a buyer's vacuum, where there's nobody buying, and this could be an accident in the stock market. Now, I don't think the market's going to, crash per se. There's risk that it could. It's not the highest probability outcome. I could see this adjusting, and you have the powers that be. Just watch financial television. Every guy on there, every woman on there comes on, they talk their book, they're bullish on stocks because it's in the network's best interest. It's in every person's best interest that's on this channel. And for the most part, their ratings go up when the stock market goes up. And now everyone's invested with the most value they've ever had in their money in the stock market. I've been doing this for 40 years. There's one mantra that rings true all the time, and that markets will screw the most people possible every single time. And in this case, it's pull the rug out from under the stock market. And yeah, you destroy that last thing. And this is part of the reason why all of a sudden with just this little tip, it's not even really fallen yet. It's not even broken down yet. It has not yet violated the uptrend. All right. It's close, but it hasn't done it yet. This little tip was enough to drive the sentiment among people making over $100,000 to the lowest level ever. So yeah, there's actually evidence to support that, the question that you would expect to hear, actually the answer you would expect to hear to the question you just asked.
Now, when it comes to, you mentioned how you've been in this for 40 years. That's, approximately, I guess, what a lot of people say, we've had a bullish stock market for about 30 years, and we've had a bond bull market, right, for about 30 years or 40 years or so, a bullish stock market for about 40 years. And some people say that, it's okay right now. We might see a pullback. We might see some sort of a crash, but long term, you can just buy and hold in the stock market. Other people I talk to say, no, there's actually a fundamental shift happening where it's not going to be a bull market in bonds. It's not going to be a bull market in stocks for decades to come. Your perspective on that? How do you see things going forward for the long term?
That's a great question. It's probably the most important question of our time, and it's an important answer because you have had a 40-year agenda. I mean, I talk about this all the time, so you're hitting on my turf here, because you have, if you look at a monthly chart of the 30-year bond yield, the 10-year bond yield, it is a perfect channel all the way down since 1981 when they finally defeated inflation. You had short-term interest rates were like 18% for crying out loud, right? And it's been a downtrend for that long in both interest rates and inflation. And what happened was we got to a level where, you took European rates negative, which was a joke because what you're saying, and they said, we're not going to raise rates for 2 years. So you basically just told the entire population, things are so bad, it's never going to get good enough that we'll be raising rates again. So give the government your money. It's the only way to safeguard it, right? Which was a ridiculous idea because it led people to believe that, things were really bad. So in the context of that, we know that negative interest rates don't work. All right. I could say that everything changed in 2008, 2009, because you have this huge downtrend. All right. But what happens when you can't keep cutting rates? All right. Well, hello to QE. All right. To quantitative easing, to printing money. All right. And why this trend is over. All right, let alone that you've broken out in inflation, you've broken out in interest rates. The trend lines are very clear and very tight and hit on for decades, right? And you've violated this. And now the pattern is the other way. What's the difference? Why is this different? Because of the debt. And I tie it into 2008. I can make this really simple, even though it is a lot more complicated. But I've done pieces on one of my themes, again, for this year, outlook ahead was crossing the event horizon, the macro event horizon. And if you know anything about astrophysics, a black hole, okay, inescapable. Once you are in a black hole, you've crossed the macro event horizon, you cross the event horizon. And you're in the black hole and you can't escape the gravitational pull. You don't know you're in the black hole yet. It hasn't ripped you apart yet, but you can't escape it. And what happened in 2008? Well, you've had GDP rising, 5 trillion, 10 trillion, 20 trillion, and you've had debt rising, and GDP has been ahead of debt until 2008. QE made it go like this. Now you have, when you throw household debt into the mix, around 18 trillion, in with public debt, which is, everyone's debt. When they say government debt, it's not government debt, it's public debt, is 36 trillion. Talk about 60 trillion in debt relative to GDP. That's not even 30 trillion. What does that mean? It means roughly you have to create $1.86 in new debt to create $1 of new growth. Why is that a problem? Well, it's a problem because if you don't have growth, you can't service the debt. And a debt deflation, like a depression, is the worst case scenario than continuing to inflate. We made this choice in the 1990s, the last time we could have gotten out and grown organically, and we decided no. And the tech bubble, what do? Same thing, cut rates to zero and so on and so forth. That was the beginning. 2008 changed everything. The pandemic intensified it. So what you have is this situation where there's other black holes. The consumer, all right, all of a sudden, all right, personal spending is higher than discretionary income on a month-to-month basis. All of a sudden, credit card debt is higher than personal savings. You're in this debt black hole. So you have to keep printing more money. It's the only way out. And when you look at like where the retail index is right now, of all the retailers, you've had, retail sales have been year over year lower than inflation for almost 18 months. It's been deflating on a real basis. People don't really understand that these numbers have been bad for a while. And now you've gotten to the point where it's above ground and everyone can see. You don't have to dig into the data details like I do to see this. And this is where it's a big difference, because the only way out is to create more debt. And to create more debt, you got to print more money. And to print more money means more inflation. And it's that simple. And it's now a long-term secular trend the other way. And the last part of the question, most important thing, okay, being passively invested in stocks will go up when the dollar goes down. It's the tightest correlation of any two markets. Dollar down, stocks up, dollar up, stocks down. So when they print more money, the dollar will come off. It will be the thing. It's already down 90% in purchasing power terms from where it was in 1976. You can debase it another 90%. It's infinite how many times you could keep debasing the dollar. Here's the problem. Stock market will go up, but it won't keep pace with the debasement in the currency in terms of purchasing power. So that's where everyone gets screwed. And you see this in countries like Argentina, Pakistan, Angola, Nigeria, just in the last 2 years. Stock market screaming to the upside, making new all-time highs, but the currency is getting so trashed that the standard of living is crashing too with the currency. That's where we're headed. I mean, it's inevitable. It's always the way it's going to be with this debt dynamic. We're in the black hole. And when you try and burn your way, burn propulsion, burn fuel to get out of a black hole, which is inescapable, that fuel is money printing. And we're going to burn it trying to get this economic spaceship out of the black hole. Problem is you can't. So we've chosen this direction. It's higher inflation, a lower standard of living, and investors that need to do other things besides just be passively invested in stocks. And it's going to become much tougher to keep pace.
It is kind of like a silent crash, right? It's been said if the stock market doesn't keep pace with inflation, then in real terms, it is crashing, even if nominally it continues to increase. So what are some of those other investments? I know gold is one that people turn to. Silver is one that people turn to that often outpace inflation when you have high inflation. Your perspective on that, gold, silver, any other investments that you think will do better than inflation in the times to come?
That's a really hard question, because when you typically talk about investments, people want to know what stock to buy. All right. So that's kind of a loaded question. Certainly gold has held its value. Gold has made new all-time highs against every currency on the planet. So in the last 2 years. So, you're starting to see it. And when you track the dollar against gold, you can see the inverse of that too. And that's the true purchasing power of the dollar. So the problem is it's going to be every currency. And the problem is that just trying to buy something in the stock market that you're going to hold for a long time, this whole buy and hold mentality is gone. You have to be either more active or get a money manager that's going to be more active. And I'm not here to give you a sales pitch. It's not my style. It never is. All right. But I will say this, and it's a funny anecdote on the side of this. I mean, I'm a CTA. Okay. So we do futures. It's the greatest tool ever. I mean, you can be long or short anything, any stock market, any bond market, any currency, any commodity, food commodities, energy commodities, any of the metals. It's a treasure trove of great opportunity. The problem is these contracts are so big. The volatility now in dollar terms on a daily basis is so wide that most people are just grossly undercapitalized. So it's very difficult for people to do this on their own. So I see what I do and what other CTAs, and there's a lot of good ones out there. You need to be aligned with the CTA, and the CTA needs to be aligned with the client. There's a lot that goes into this. It's not just, hey, just send us your money, we'll take anyone's money. It's not how it works in this part of the business. But someone that does what I do will be much better served to help people do this, because you're going to need to be in the commodities. You're going to need to be in the currencies. You're going to need to be much more nimble and not holding things for as long. And, some of these commodities, I've been doing this so long. And it's funny because I've been kind of saying this since, I was, coming up in the markets in the 80s, when the 87 crash hit. It was kind of one of these things. They printed $100 billion, which is chump change now, but it was a huge deal. And everyone thought inflation was going to come then, and it never did. And somebody said to me, it was one of our newest investors in the money management business. And I said to him, I go, people that do what I do will become much more valuable in the future. And he goes, you've been waiting the whole call to tell me that. And I said, I've been waiting 35 years to tell people that, because this is where we are. And this entire evolution that I have watched in my entire career brings us right here to where, if you're not positioned to take advantage of these types of things, you're going to get lost in the shuffle.
When it comes to, I guess, what you're seeing happen with gold right now, a lot of people also, are you looking at silver as well? Because people are, I guess, disappointed that silver is also not at all-time highs, right? Even though it's, pretty much possibly outperformed the last 12 months or close to gold's performance the last 12 months. So your perspective right now on gold versus silver?
Yeah, it's another good question, the one that a lot of people are asking, and there's a really good answer. I mean, it's interesting, and yes, I am frustrated too, because you buy silver and it gets above 32.50, and then it cracks, and it's like in and out, and it's at risk, as are all assets. If the stock market does in fact go into kind of a meltdown mode, then all asset prices could come off. That's when you would expect to see what we saw in 2008, where gold and silver fall less, all right, and they hold their value better. Doesn't mean it can't be down 20%. So there's risk there for sure. Having said that, all right, silver's performance has been phenomenal when you take into account the dollar has been higher for the most part until just recently. So in that context, there really is a waiting game with silver, because it is going to be much more correlated to a dollar decline than is gold, because gold has the whole BRICS unit thing going on. And let me tell you something, you cannot naysay or, belittle the BRICS unit thing. That's going to happen. All right. It's been slowed down by Trump. It's kind of been put on the back burner. But it's a mechanism that's blockchain based that will allow these countries that don't want to use the dollar anymore, don't have to use the dollar anymore. China is, 50% bigger trade on a monthly basis than we are now anyway. 300 billion imports and exports. We're at 200 billion plus. So, they've already taken over as the dominant trader of the world. And when you want something like this, where you can have trade between, for example, Philippines and Thailand, where they can use their own currencies partly, and then gold, and then the Chinese renminbi, and have it exactly measured to whatever you're, exchanging in goods or services. All right. And in that context, all these countries need to have gold, and they need it on hand. So what you've seen in gold is central banks buying gold like crazy for the last 2 years, 18 months. When you look back to really 2022, U.S. investors sold their ETF holdings of precious metals, sold the individual mining shares, got wasted, and indexes got wasted. What the buyers have been central banks, and the buyers have been central banks like Brazil. I mean, so Brazil, for example, 80% of their reserves of $100 billion is treasury bonds. So what are they going to do? They're going to sell bonds, use the dollars to buy gold so they can participate in the BRICS. That will happen. Again, it's been slowed down. But the point is, this rally in gold has been on different levels. That number one. And then number two, just again, the continued debasement of the currency, whether it's inflation or money printing or eventually some combination of both of those things. Gold is the ultimate hedge there. So not necessarily silver if the dollar's still strong. Silver will be in play when the dollar cracks. We're awfully close to that happening. And I think the frustration, those who are patient, it will pay off, because it's going to go. But gold is still like the key asset when you talk about paper currencies, when you talk about BRICS. Silver's not involved in any of that, so it's lagged.
And what will be, I guess, you mentioned how if the dollar breaks, that'll be the catalyst for silver to move. But who's going to be buying, what population is going to be buying silver if, all these BRICS nations are accumulating gold? Who will be the buyer of the silver?
Buyer will be the U.S. investors. The buyer will be anyone that, plays off the dollar to begin with. And I think you could see a huge repopulation. I mean, open interest is not high. The ETFs are not widely owned, even the mining shares. I mean, if you look at the mining shares, they're actually starting to break out not only on their own merit, but against gold and against silver. And more importantly, the GDX, so the gold mining share index, is breaking out against the S&P, has outperformed by double digits over the last 52 weeks. So this is something new, and I think this is part of a bigger rotation in the equity market, because I'd say we get to a point where you get a lower value for stocks and it kind of goes sideways, and the Fed comes in as the consumer's struggling, all right? What's going to be the leadership? Is it going to be AI tech? I think that's played for now. All right. Is it going to be a consumer? No. Is it going to be the Chinese, trade dynamic that's been a juggernaut for many years? No, obviously not during tariffs and this whole, kind of, hostility between the two countries. Where's the leadership coming from? So I would say the leadership might be safety. We've seen some of that in that the utilities have performed really well lately, as opposed to some of the tech stuff. But when you see the GDX start to break out against the NASDAQ and the XLK Information Technology ETF, that's a big deal to me. And I could see a rotation of capital from the Wall Street crowd, the money management crowd, into the mining shares that then could kind of be the catalyst. But really watch the dollar. And when you're looking at the dollar, there's 99.57 on the cash dollar index is a critical technical pivot for so many reasons. I mean, it's a convergence of all kinds of different technical indicators and history at that level, where if you get below 99.50 in the cash dollar index, that's going to be a secular breakdown. You have 10% of downside from there almost instantly, just because of the way it's all set up from a technical basis. So I would say, you're going to see silver much higher when the dollar, is below 100. And it's going to happen fast. And I would almost go so far as to say, when the dollar cracks, it's not a question, does silver get to $50? It's a question of how fast does it happen?
It should be exciting times ahead. If people are interested in looking you up, really subscribing to the Global Macro Strategy Report, how can they find you?
Sure. Thanks. I appreciate that. You can email me directly, Greg Weldon, GregWeldon at Weldon Online. That's one word, weldononline.com. You can follow me on Twitter. I'm at Weldon Live. I'm on YouTube, Gregory_Weldon. But emailing me is the best way. I'll send you samples of the research. It's every day. It has specific trading recommendations, stop levels in all of the sectors: fixed income, foreign exchange, global stock indexes, metals, energy, and agricultural commodities. We have investors from the world's largest hedge fund all the way down to retired people down here in Florida. So it's usable and it's daily, and we're all on top of it. And then, of course, we have the money management, which is for accredited investors only. It's it's a high minimum investment, but that's because you need to be highly capitalized to trade these markets these days. And I will tell you, we have done very well since we opened this specific program, which is designed to do exactly what I was talking about now and into the future, which is protect the purchasing power of people's money, income, and wealth. So send me an email. I can send you information on that as well.
Fantastic. Any last thoughts before we let you go, Greg?
Yeah, be safe out there. Take cover. I mean, how about this? Financial prophylactics. So I think people need to take some protection here. I'm not saying the markets, you've had a pretty nice move already. It's already 9% move. But, if you're going to see something more along the lines of 20 to 25%, you still have some length on the downside here. And then I see a market that maybe goes sideways. And everyone kind of thinks the Fed's going to come rushing in on their white horse and save the day. And I always say it's kind of like the 1960s, war saying, where they have a picture of a flower child sticking a flower in the gun of a soldier, pointing the gun at her, right? It's got the bees around her head and all 9 yards. And it says, what if they gave a war and nobody came? And I kind of say, what if they gave QE and nobody cared? You have to do a lot of QE now with all the debt too. Every QE needs to be exponentially larger. So I would say, really be careful and, really make sure that you're just not following the crowd, passively invested with, Joe Blow, global wealth manager who has all the same stocks, all the leading stocks. I think that, longer term, that's going to be, you're doing a disservice to yourself.
We really appreciate your time and insights today, Greg. Thank you so much, and God bless.
My pleasure. Anytime.
Now through Monday, April 7th. In honor of Silver Squeeze 2.0, for any Monster Box of Silver Eagles, we'll give you 2 additional Silver Eagles at no cost. And unlike some other Silver Squeeze deals, there's no limit. So if you purchase 1 Silver Eagle Monster Box, you get 502 Silver Eagles. If you purchase 10 Monster Boxes, you're getting a full tube of Eagles for no cost. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.